Good morning. Welcome to Market Monday for May 27th, 2024. Today, even though our offices are closed along with the markets, it's our great honor to remember the U.S. military service members who have made the ultimate sacrifice in the defense of our country. It's these individuals and those who have served or are currently serving that allow us our freedoms that we enjoy and too often take for granted.
One of those freedoms, of course, is serving you and being with you here on Market Monday. Well, after a brief pullback, we're back to all-time highs, that is. So does that mean the market has to crash from here? Here are the number of all-time highs in each calendar year since 1929. Okay, maybe let's just start since 1950, and bang. 27 new highs, followed by 49, then another 14 in the mid-50s. 60s also had quite a few, year after year. Then a couple years of drawdowns, back to new highs. Then wow, runaway inflation of the 70s caused a 6-year drawdown before seeing new highs again. Obviously, 80s and 90s were on fire, followed by a 6-year drawdown, finally getting back to another all-time high, then bang, another 5-year drawdown. And we know the story over the past 10 years.
Couple observations here. One, as we've discussed many times before, markets tend to trend. They can go on these really long runs after making new highs each and every year, followed by an utter drought. Number two, anyone remember the pain of 2022? Just a brutal year, especially for diversified portfolios. But it still had an all-time high on January 4th. So number two, this doesn't necessarily capture the potential brutal times in the market. The main point here is, generally speaking, do not fear all-time highs. And more often than not, lean into them. True, sometimes inevitably, an all-time high will be at the end of a run. But as long-term investors, we should plan for this feature rather than fear it.
And as Chad just said, sometimes a new high comes at the end of a run, but that's more the exception than the rule. So are all new all-time highs the same? Remember this, the source of returns for the stock market. Stock market returns over long periods of time are driven by earnings, the so-called mother's milk of the stock market, this green area here. This is just showing the year to date through 2024, so it's not a long-term commentary.
And the other driver of returns, the $10 word, is called multiple. Essentially, how much are investors willing to pay for these earnings here? Multiple growth or contraction tends to be a lot more volatile, driven by emotion and narrative rather than fundamentals. So back in March, the market was up 10%, but only 3.1% was from earnings, and 7.1% from multiples expansion, or the market getting more expensive. Now in mid-May, we have the market up about 11%. Of which 5.3% is coming from earnings and just 6% from multiple. So in this frame, a healthier new all-time high.
So as the market has recently hit another high, that brings us up 9% above the average analyst year-end target. You see the average price target here, and here's where we currently stand. Wow, so many smart people, the resources of global firms at their disposal, armies of teams crunching numbers, AI and machine learning, and utterly wrong. Folks, nobody can predict the future. Nobody. And now everyone begins raising their price targets. Here's Morgan Stanley's Mike Wilson, who has been especially wrong over the past few years. Here's his old target down here at 4,500. Here's that same 4,500 level here. And oops, Only after the market soared well above that, he raised his new target up here.
And today we'll leave you with some fast food inflation figures. And we thought auto insurance was bad. Have a great week.